As an Indian company or maybe an Indian business, I would say, you might be taking certain services from a non-resident. And when you make over these payments, the bank might be asking you to get a certificate from the chartered accountant as to what is the amount of tax that is payable on such payments. Now, before you understand as to how much tax has to be deducted, there are a few things that one you should keep in mind. While this is a very detailed subject and not possible to kind of comprehend this in one small video, some of the key aspects that one should consider when making payment to a non-resident are discussed in this video. So let's say you are an Indian company that takes the services from a foreign company. The first thing that you need to understand is that there is an Income Tax Act and there is a tax treaty between India and the country of the resident of the taxpayer. As a rule, the provisions of the Income Tax Act or the tax treaty, whichever are more beneficial, applies to the foreign recipient, which means that if the income is liable to tax under the Income Tax Act but not taxable under the treaty, the non-resident is not supposed to pay any taxes in India, and therefore the amount of TDS that has to be deducted will be zero. On the other hand, if under the Act the payment is not taxable, then you don't need to go and look into the treaty. The withholding tax will again be zero. But whenever a person says that his income is not liable to tax because of the provisions of the tax treaty, then you have to obtain certain documentation from them. And basically these are a Form 10F, a no PE certificate, and the proof of tax residency of this person of the country for which he wants to claim a benefit of the tax treaty. The benefit under the tax treaty cannot be given if a tax residency certificate is not available for the foreign company. So from your perspective also, if you are withholding a particular amount of tax, these three documents you should always request and have before you give any benefit under the tax treaty. However, if the benefit under the tax treaty is not claimed, in such a case, under the Income Tax Act, you can deduct tax on these kind of services. So let's say on fee for technical services, if the non-resident has a permanent account number in India, the tax rate is 10%, but this will be topped up with the surcharge and the education cess. Whereas under the tax treaty, generally these two are not applicable. Sounds complicated? Okay, if you have any issues, you let us know in the comment section and we will check out as to how we can help you decide the right amount of taxes that you have to withhold so that tomorrow these taxes are not recovered from you.